Welcome, everybody. So this is Haichen Yi from CUHK Shenzhen. I will be chairing this session. And in this session, you will hear two fascinating stories related to lending in China. One is about corporate foreign bond issuance and interfirm loans in China. And the other is about hidden non-performing loans in China. Just before we start, just a reminder of the rule of engagement. There will be 15 minutes of presentation, followed by 15 minutes of discussion. And afterwards, we will have 15 minutes of question and answering. Okay. For panelists and attendees, if you have any question, please feel free to post your question in the chat room, and we're going to open the floor during the Q&A time. All right. Without further ado, let's welcome Professor Huang from the Graduate Institute Geneva to give us a talk on his work on the corporate foreign bond issuance and interfirm loans.
Hello, good afternoon, good morning, friends from Europe and Asia and the US. And today I would like to present one paper. Again, firstly, let me thank the organizer to include our paper in this section, and looking forward to learn from your insights. So this paper joined with my former PhD advisor, Professor Richard Portes. I guess he might be in today's Zoom talk as well. And also my colleague, Panizza from Geneva. So let me share my slides. And thanks for my excellent discussion. I'm looking forward to comments. Let me start to share my slides. So this is a paper joining with Hugo and Richard. We try to understand better about corporate bond borrowing in China. And let me skip this part. So firstly, let me try to show some motivations. So aftermath of a global financial crisis was associated with a surge in credit to non-financial sector in foreign borrowing by emerging market nations. Okay, and why this is important? Because if you look at the data from the BIS, China plays a major role in terms of dollar bond borrowing, especially for Chinese non-financial firms. Okay, if you look at the left-hand panel, blue bar represents other EM country. There are small, tiny red bar represent China. But just after 10 years later, if you look at red bar in China, it's more $10,000 billion outstanding international borrowing issued by Chinese non-financial corporate. So this paper will try to understand this rising foreign currency borrowing by non-financial firm in China to understand what's the driver of bond issuance, and especially we try to describe how bond issuance use, so proceed, and more importantly, the real effect. Okay, those are overall the motivations. So what happened in China after global financial crisis? So background for China, including institutional setting as following. China react to global financial crisis with massive fiscal stimulus. In November 2008, the government announced a package worth 4 trillion yuan, probably US dollar 590 billion stimulus package. This policy action tightens the credit condition faced by Chinese private firms. Okay, in China, we have private firms or state-owned firms. Okay, we're a big firm, a small firm. But now, based on our research, my recent paper with Hugo and Marco Pagano, JL paper, we try to look at this kind of clouding out effect. And the same paper by, now Chair Lady and Ling Shu have an offense paper document a similar pattern in terms of a global financial crisis, tightened credit condition for Chinese non-financial firms, especially for private sectors in China. So in the line of this research, this paper also tried to characteristic by a set of regulation reform that tighten access to the credit for firms that belong to economic sector deemed to be a so-called risky sector, or zombie firms, or excessive capacity firms. So a lot of regulation try to forbidden domestic credit to those firms, especially once you are classified as a risky or overcapacity or zombies. Okay, those policy was associated with a rising in shadow banking rate, so-called Wenzhou rate in China, faced by Chinese firms, especially private firms, which increasing from probably 30% in the winter 2009, 2010 to around 20% in middle 2011. Okay, So jump of issuing international foreign currency did not bond by Chinese non-financial firm happen same times. Okay, so that's why we try to link two things: one for domestic credit crunch, high borrowing cost, and another we see a massive jump in terms of issue foreign currency denominated bond. So this overall interesting settings. So second question, people ask me, what kind of sectors they are? Okay, so we borrow the definition from our Ministry of Industry Information Technology and Zhao Kaiji's paper, AER paper. Risky sector including real estate, iron, steel, a lot of non-tradable sectors in China. Okay, we follows the standard classification by Chinese Ministry of Industry and Information Technologies, and those sectors which have forbidden got a loan from domestic financial sectors. Okay, so we are looking at how much this kind of risky sector borrow internationally compared non-risky sector, and what's real effect as not control and treatment group. Okay, so this is overall in-stream settings. So what's now main findings? Now main findings is very strict. So main finding is following: dollar issuer is positively correlated with differential between domestic and foreign interest rate. The effect is particularly important for firms that operate in risky sector. First one. Second one, issuer of dollar bond has lower investment rate and more likely to lend to other firms. Thirdly, firms in risky sector do more so-called interfirm loans, lendings, which is a major contribution for this paper, then other firms operating to other sectors. Okay, interfirm lending by firm operating in risky sector and issue dollar bond increased after so-called regulation tightened in 2009-2010. Okay, finally, we also have new evidence. We use the data of interest loans. Okay, interest loan confirm most interfirm lendings is within same sectors. And what really matters is difference between RMB lending rate in the interest loan contract and the dollar borrowing rate, so-called carry trade. Okay, this is the four main findings from our paper. Okay, let me explain very carefully about the settings and also, of course, the contributions to the literature. We try to link with our paper with a three-directional literature. Firstly, we try to understand the new phenomenon, so-called foreign currency borrowing by non-financial firms. Start Bruno Xing, start Xing and Zhao, and recently by Virachaya and his colleague used the data from India. Okay, also Ugo's paper with Latin American countries. Okay, second line of direction of literature, we try to understand monetary policy in China and what happens to shadow bankings. You know, Bernie and Yonghen and Mark Wu Jing have a fantastic paper try to understand Chinese monetary policy during that period. I highly recommend to read. Also, all of the paper I'll try to highlight here. If I miss any literature, please let me know. Okay. Finally, we try to understand the access to international financial market. Okay, what's real effect? How to deal with a partially capital account liberalization, or so-called how to deal with capital account management in the name of a regulation and policy recommendations. Okay, there's all three literature we'll try to highlight. Firstly, what's our data looks like? We merge bond level data, bond level issuer data from deal logic. Deal logic including all bond issue informations, okay, issue informations, maturity size, you know, which currency, where borrowing, with firm level data from China stock market accounting research data sets. So we have balance sheet and the issue informations. Also, we use the merge last part of the data is hand collect data about interest loans. Okay, interest loan data, we know the borrowing cost compared to dollar borrowing. Okay, we can calculate spread. Okay, and also more importantly, we want to highlight, we collect information on all bonds issued by Chinese nations, okay, rather than residents during period 2005-2015. As we know, based on fantastic work, BIS document and Bruno Xing, the focus of nationals rather than residents is important because over 2009-2015, the massive increasing of internet borrowing through by nationality rather than residents. So I just plot very simple different. In the left-hand side, national level issuer compared to residents, the difference big. Also compare now data with deal logic data. Our data is very consistent with the BIS aggregated data from our deal logic data informations. Okay, now data set. And the second one, we want to say specification. First question we try to understand is correlation. What's the driver of a US dollar bond issuer? We estimate different versions of following linear probability limit models. In left-hand side was issuer from I, EAT is dummy variable to take value 1, your firm I issue dollar bond EAT compared to RMB, another currency. Okay, also size as a flow or outstanding. Okay, to look at external margin, internal margin. So we also control a lot of firm characteristic. More important, I want to highlight so-called carry trade index. The benefit of carry trade. We got data from Bloomberg Carry Trade Performance Index. The index measure 3 months return of borrowing dollar and investing RMB. What's the benefit? Also, we calculate the shadow rate with the private lending interest rate in domestic China through shadow banking sectors. We try to understand why is the dollar borrowing follow because of a non-financial firm in China try to get carry trade benefits. Okay, we'll also estimate different version of the equation with the year from fixed effect. Due to time, if you're interested, take a look in our paper. It's an appendix. We do a lot of robust check. Okay. Firstly, allow me to show the correlation. What's the driver Chinese non-financial firm issue dollar bond? Left-hand side, linear models, probability model, issue or not issue. We try to emphasize 2 parts. Number 1, we'll look at if you are risky sector. The red box shows most of them are highly positive correlated, significant. Okay, if you're a risk sector, you're most likely to issue dollar bonds. Okay, also with interaction terms between risky sector and the carry trade benefit. We also found out when the risky sector, when carry trade benefit is higher, you have a more positive correlation with the dollar bond issuer. Okay, firstly, risky sector. Secondly, when carry trade benefit is higher, we issue more dollar bond. Okay, this is the first result in terms of what's the driver for foreign currency borrowing in China from non-financial firm in China. Secondly, so suggest the theory always try to suggest us the bank borrowing to lend, positive correlation, non-financial firm borrowing for invest, positive correlation between debt and fixed investment. Bruno Xing and Zhao is the first paper try to argue this is the case for advanced economy. However, in EM countries, they often found non-financial firm behaving like bank, they borrowing to lend. Okay, once they look at 2-dimension investment. When for borrow money, why do they invest? Secondly, they look at cash coding. In our paper, we first try to confirm that result, and maybe we try to argue what's new here in China. Okay, let me start it. So we focus on China. First equation, we look at left-hand side, fiscal investment. So we look at when issue dollar, you do less investment, fiscal fiscal capitals. Okay. And then second question is very different, like we learned from the carry trade literature. What happened to cash coding? So we also look at interest left-hand side cash coding for firm when issues dollar. We don't find any significant result, no matter dummy, issue size, or outstanding of debt. We find no result. Okay? Then we have to think. And thank you very much for all our friends give us suggestion. Also, now courses give us some time to give us a lot of discussion to think. What happens? It's puzzling. Because you borrowing dollar, you have a carry trade benefit, you put more money in the local currency bank, you can yield high carry trade benefits, evident from Brazil, but not necessarily in China. Because if you look at now, this right-hand figures of recent paper, jail paper, try to show the bottom dotted line is policy rate, interest rate. The dark black line, those is the spread between policy rate and lending rate, which means firm cannot put into the bank because interest rate low. They tend to be borrow internationally to lend. That's why now people try to argue. Okay, what do we look like? We look at balance sheet of a firm. We found out one very nice item called Interfirm loans. Okay, we look at Interfirm loan compared to when the issue dollar, when carry trade benefit is higher, when shadow borrowing cost is higher. We do find out very significant. No matter issuer, when issue more dollar debt, you do more Interfirm loans, especially with interaction terms. Do with carry trade, with shadow rate, we do want significant positive. Which means when carry trade benefit is higher, when shadow rate domestic borrowing cost is higher, when the issue dollars tend to lend to each other, so-called interfirm loans. Okay, the robust check will also become stronger if we exclude state-only company, which means a lot of results driven by private sectors, zombie firm, risky sector, overcapacity sector. Okay, this is the first most important contribution for this paper. Okay, from borrow in dollar, went back to China, lend to each other. Okay, this is the first main result. Secondly, we also look at control variable in terms of once we control RMB borrowing. Once issued RMB denominated bond, what happens? We still hold the result for the issued dollar, but when we do interaction term with carry trade with US dollar, was still positive significant. With issue RMB with carry trade, we didn't see any result. Okay, which means most result was also driven by when issue dollar, then carry trade benefits higher, you do more interfirm loans. Okay, which is not happen for carry trade, sorry, for when the issue RMB denominated bonds. Okay, that's the first robust check. Secondly, we look at the internal margin, external margin, we look at issue dollar in dummy or amount. We do find the most significant once the issue dollar in amount, there tend to be more interfirm loans. Also, once carry trade benefits higher, the firm tend to be more interfirm loans. In terms of size and dummy, size matters, amount matters. So external margin matter more compared to essential margins. Okay.
You have 2 minutes left. Sorry.
Oh, okay. Sorry. Let me. It's a lot of interesting result. Okay, let me skip it. This is heterogeneities. We look at interaction term issue and the firm characteristic. I found the firm with a low ROA, risky firm, SOE. You know, they do private sector. They do more in terms of interfirm loans, in terms of heterogeneity, cross sectors, and the firm characteristic, industry characteristic. Okay. Last but not least, let me go through the most important results. So as I mentioned, so risky firm issue more dollar debt, especially when carry trade benefits higher. Firm like issue more dollar bonds, do not invest more. Firm issue more dollar bond, lend more to other firm, especially when carry trade returns higher, especially the operating risky sector. Then we look at this kind of regulation reform. So regulation, don't lend to firms through central bank regulation. Don't lend to credit, domestic credit, to those zombie firm, risky sector. Then we look at the results in terms of difference. So result look like once the risky sector, when you cannot issue dollar bonds, okay, when you start issue dollar bond, when regulation change, you do more interfirm loans. So we try to use this as a quasi-experimental shocks to look at how firm responds. Okay, was in line with the result about Zartow's AER paper. So mainly look at domestic event, so-called shadow bankings. We look at the international dimension. We look at interfirm loans when regulation is higher. From now, a risky sector tend to be more like risky arbitrage. Okay. Okay, due to time, let me go through last part of result is interest loans. Interest loan is part of loans through the banks, and we just check every single announcement for interest loans through listed company in China. For example, so one example for Zhenjiang biotech companies, they want to lend money to real estate company, but they cannot lend directly because of regulation. So go through the bank, so called interest loans. Then from this announcement, we know the amount, maturity, and interest rate. Okay. Then exact the same exercise we try to answer dollar issuer time spread between average interest rate on interest loan minus average interest rate on dollar bond. Also, we also test average interest rate on interest loan minus average interest rate in RMB. So we do two interaction term. We do find out once spread is higher for dollar, so firm tended to be once each dollar bond tended to be more interfirm loans. Okay, which confirm now funding from previous one. Previous one we look at the quantity, now we look at quantities. Previous one we look at the levels, the change, the growth. Now we look at the price. Okay. Finally, let me conclude. So this is the funding is not in line with the hypothesis. Firm issue liability structure jointly minimize funding cost and the currency risk. We are instead consistent with hypothesis like Bruno Xin papers. Firms that operate in risky sectors try to boost probability by engage activity mimicking behavior like financial institutions or carry trade. We also look at regulation arbitrage. We found out the regulation aim to limit domestic leverage for risk sector may create an incentive for moving to more risk sector, so-called foreign currency borrowing. Finally, financial policy implication, financial stability in both EM, advanced country, is growing important in the light of regulation for non-bank financial institution. Firm as a shadow banking. Okay, nice report by BIS and ESRB's paper report. Highly recommend to read. Thank you very much. Thank you. I hope I put all the language here.
All right. Next, let's welcome Professor Marlene Amstad to have a discussion on the paper.
Okay, so thanks very much to E for the very exciting presentation as always, and very much thanks also to the organizer to give me the opportunity to discuss this very interesting this very interesting paper. This paper is really overall I really like it a lot. It's a great paper. as you can see when you from the first part, it's has been presented already quite often, received already many comments, a joy to read, but it's not that easy to comment on because there had been already lots of comments and presentations. So I'll focus on a few aspects that I would suggest to further explore the paper. In terms of summary, I will be brief because, as always, he gave an excellent presentation of the paper. But very short summary is the starting point is that US dollar denominated bond issuance by Chinese non-financial firms rose dramatically after the great financial crisis. And there had been a policy change 2009-2010 that affected risky sectors. We will cover this in a minute, what's meant with risky sectors. The main findings are that the firms in these risky sectors, they issue more often in US dollar. And this is particularly the case in times of high carry returns. And the same firms, so these firms in risky sectors, they lend more to other firms in these risky sectors. So they essentially work like, they behave like a financial institution in lending in US dollar abroad, in borrowing US dollar abroad, and then lending in CNY in China. So my comments will focus on the different regressions presented in the paper, and I'll first focus more on the dependent variables that are used, then more on the independent variable, and finally I'll have some comments on the shock identification, which is basically this regulatory change that occurred around 2009 and 2010. So first on the dependent variables. So for sure, US dollar denominated Chinese bond increased dramatically. So now the question is why? Why is this the case? And this paper mostly concentrates on reasons on the supply side of bond issuance. So increased US dollar bond issuance by Chinese nationals result from lower cost. So it's just cheaper in US dollar than in CNY. The interest rate differential matters. Then those firms use this interest rate differential to benefit from carry trade, as I just vividly described. And it's just easier in US dollar because this is less regulated than in CNY. So there is a push factor out of the CNY into foreign currency. And this is all perfect. What I wondered, reading through the paper, is that there might be also other supply side factors, which to me seem not currently fully covered in the paper. So one part is that the Chinese bond market is heavily segmented, and this is particularly the case for corporate bonds. So it's not just a matter of a company that wants to issue a bond. It's not just a question of in which currency, but it is also within the currency. It's very much a question of which type of corporate bonds is issued, and it's given that this is quite particular and distinct to the Chinese bond market. I think it would be great if the paper could add some more information on whether these different types of corporate bond markets are differently affected by the findings and these impact, and particularly whether there are particular bonds that have more a tendency to lend then further on to other corporates. So there are different markets. So we have the interbank bond market where this is traded. We have the exchange market there as well. It would be interesting to see, is there a difference in terms of, so which corporate bond market actually is most affected? Are they all affected the same by your findings, or are there specific differences? And this might also matter because the liquidity is really different in these different types. So an issuer might be tempted to say, okay, I actually prefer to issue in US dollar because the liquidity that I observe in particular types of corporate bond markets is so low. So this might be an additional factor for the observation that you see a preference for US dollar dominated issuance. Same for the availability of derivatives market. So that also not just the regulators, not just the market differs across these different segments, but also the availability of derivatives market. So all of this, I think, would be great to see one or two more factors that you include on the dependent side of your regressions. And then there are I don't just have a few papers that I would maybe add to your already long list of references. So one would be the one by Paul, Why Do Firms Issue Abroad? Lessons from Onshore and Offshore Corporate Bond Finance in Asian Emerging Markets. And he goes through several different characteristics of the firms. And so, for instance, they find that the age or the number of years listed on stock exchange is an important factor. So I believe that would be important also to include in your dependent factor. So then, in addition to add to focus on the supply side, I believe there are also major shifts in the demand side of Chinese bond issuance during the same time. So particularly we see a major catch-up demand by global investor in overall Asian, but particularly in Chinese bonds. And this matters for this paper because in case of China, due to capital controls, the demand is shifted towards US dollar instead of local currency issued denominated bonds. So when we see this actually in the inclusion of global bond indices, that there first basically this appetite for more Chinese bonds, corporate bonds, first shows in the US dollar-dominated space, and because of we have these capital controls, only slowly then feeds into the CNY-denominated market. So this might be an additional driver, and that might differ also over time. I suspect that something like this is at work when I look at your regression. So once you correct for firm but also time fixed effects, the results change quite a bit. So I guess that these type of additional demand side drivers of the Chinese bond issuance might play a role. And then another demand side factor would be that you have a much broader investor base in US dollars, so it might be more liquid. So foreign investors in CNY are only around 3%. And it's much easier to access foreign investors through issuance of US dollar denominated bonds than through listing on the Chinese equity market. So this is another demand factor that might also drive the increase that we definitely see. And finally, foreign investors might also suffer from higher information asymmetries, which leads me then to a second point about the pricing. So maybe it's not just a matter of increased regulation, but it might be also a matter of mispricing in the US dollar space. So this is all on the dependent variable. Now on the independent variable, now on the dependent variable. So how to measure this decision on currency? So currently in the paper, if I understand correctly, or if I have the most current version, it's mostly a dummy variable that is used. First, I'm not sure why you use OLS instead of probit and logit. And then I think also it would be important to use the volumes. So do the riskier sector borrow more often, or do they actually borrow more in terms of volumes? And in particular, I think it would be interesting to have a dependent variable as the share of bonds denominated in CNY versus US dollar per firm, because then you can really carve out this choice, whether you choose either US dollar or CNY. And finally, I think it would also be important to introduce the interest rate, because when riskier firms borrow more often in US dollar, but they also have to pay more, therefore they have less incentive to hold cash and more incentive to lend to firm, and in particularly in the same and in riskier sectors. So in essence, you could say that the paper actually suggests mispricing of these bonds in these riskier sector firms, because this carry trade would only work if these riskier sector firms do not have to pay more. So I think that's why the interest rate would be important to look into, to which extent this is not already priced into the interest rate, so the carry trade option that those company have. And then finally, in terms of identification of the shock, so you basically you focus on this this policy issued around 2009 and 2010, and I might be wrong, but if I understand correctly, then the measure of riskiness refers to 2014. So you provide this table on the sector classification, and you mentioned that basically you follow Chen et al. And they follow the Ministry of Industry and Information Technology of PBOC. And you refer here to 2014. So the question is, does this matter? So, I mean, is that not quite a large gap in terms of the policy issued, and then also when you measure the riskiness? And another question would be, does these regulations, do they really affect only CNY issuance and not overall risk? So when I read through the parts that you provide in the paper, it stays silent actually on the currency. It just says that these type of sectors are basically curbed. Their lending is curbed. It says silence in terms of whether this is mostly in CNY or whether this is in overall risks. And then it would be, so your data is currently on 2009 to 2015, and of course it would be particularly interesting. You would have an even better case for your paper in the phase that started in 2017, when the so-called regulatory storm started, and when we saw really tightening in these markets. So it would be very interesting to if possible, we have a great data set. So if that would be possible to see whether whether this bans or whether this shows actually also in this tightening in 2017. And then more generally, I ask whether you actually need this policy change, or whether instead of this policy change, you could actually use a firm or bond rating instead of these sector ratings. Because when I look into these sectors that are considered as risky, it's not that easy to pin down what is the approach to identify a sector as risky or not. And so that's the approach that was used to define the risky sectors. That would be interesting to add. And then why not use directly the firm or bond ratings? I'm fully aware that in the CNY, when it's CNY denominated, you have this major issue that corporate bonds are basically not differentiated in terms of rating, but you are in the US dollar space. So there I would assume this is much less of an issue. So, and with that, I'll end. So it's a great paper. I very much enjoyed reading it. I think the most important contribution here definitely is that you were able to carve out and show that these non-financial companies, they have this tendency to lend out as kind of financial institution-like. And I think it would be most interesting to see whether in this most recent policy change in 2017 onwards, whether your findings hold, and would be interesting to add a little bit more on these dependent variables. So currently you focus mostly on the supply side, and there are other important demand side factors that I think would be important to include. But overall, already very well polished and most interesting paper. So thanks a lot for the opportunity to discuss.
Thank you, Marlene, for excellent discussion. So, would you like to take some time to respond to Marlene's comments and suggestions?
Of course, again, many thanks for your insights, and really like your comments, Marlene, as always. So let me start from the reverse orders. So number one, indeed, we have information about ratings through deal logic. So deal logic is the data set, every firm rating which kind of a bond. We do have information. If I remember correctly, this project started 2014, I guess. As well 14, it's a long time, but we go back to see the result. We do have some result about ratings. Due to the size of the paper, we have to put the more important result in the main results and put the rest in the appendix. Indeed, rating is workable. Secondly, ask a very important question in terms of how to classify risky sector, non-risky sector. So when we cite the paper, Zhao's paper, Kaichi paper, this classification was defined by our government. So once the paper revised, finally published, so also take time to know, whether the change or not. Now it's a very common thing for the paper published in top journals, especially top 5 journals. But indeed, I really like your comments in terms of how to deal with the liquidities. Let me start with why. Because you talk about government regulation, we try to argue this kind of regulation might have an unintended consequence. Let me explain why. Because at that time, after the global financial crisis, China massive fiscal stimulus, massive capital getting to the market. Then a lot of misallocation getting into the risky sector, including real estate, a lot of overcapacity sector, zombie firms. That's why, regulators say, look, also domestic, let me repeat again, domestic financial institution, don't lend money to those guys, so-called risky sector. So only thing changed for them as long as they have access to international bond market, to dollar bond, through Hong Kong mainly, then New York, issue majority dollar denominated bond. Second one is Hong Kong denominated bond, Hong Kong dollar back to US dollar. So mainly they do try to do this kind of arbitrage as long as they have access. Okay, this is a domestic policy, but they might have some unintended consequence. More importantly, which allowed us to think more in terms of monetary policy, how to deal with capital controls, how to understand better in terms of partially or fully capital account liberalization. So rethinking about access to international financial market is beneficial, risk-taking, risk sharing is kind of a so-called diversification. A lot of benefits we learn, but they might have some unintended consequences, especially for a country like China. We have a lot of frictions. We have a lot of different institutional settings. So that's why for those animals, those risky sectors, zombie firms, overcapacity sectors, they cannot borrow money from domestic China, from financial institution. As long as they can borrow internationally, they get money back. So this is something, sorry, due to time, it's a long paper. I have enough time to explain, the regulation shocks. Of course, we can do, ideally, we want to do more recent data. Because theological number one is very expensive, very big. So we got data at the end of 2015. That's why we didn't take into account in terms of longer enough data for 2017. Okay, this is the one thing. Of course, we can do this off some study, look at interest loan plus firm level evidence to look at whether they follow the same trend or not. And last but not least, I think very important to look at liquidity. So in China, indeed, we have corporate bond, enterprise bond, local government bonds. So for my linear, this kind of probability model, we only mainly look at currency denominated, rather than in terms of what type of bond. We can do a robustness check. That's easy because we know all type of bond. Then we can see whether a dollar bond with the most regulated bond, corporate bond in China, dollar bond with the most liquid bond in China or not. So we can do a robustness check to answer all the fantastic questions you just raised in your fantastic, excellent comments. Thank you very much for your insight.
All right, so here we're gonna have the Q&A session now. Now, currently I'm looking at the chat box. So there are two questions. So first, Professor Takio Hoshi, do you wanna ask a question? Yeah, you can just unmute yourself.
Sure. This is a very interesting paper. And my question relates to one of the points Marlene mentioned, of the mispricing. I want to find out who buy these bonds issued by risky firms, right? So one possibility is foreign investors who do not understand Chinese firms. In that case, I would like to know who are these fools, right? And another possibility I can think of is this is what we observed for Japan in 1980s. The many Japanese corporations issued bonds abroad. Most of those were bought by Japanese companies abroad. And, people talked about sushi bonds. Only Japanese guys, Japanese companies buy those bonds or eat those bonds. And they did that in order to get around the regulation in the domestic market, which may relate to what you mentioned in the Chinese regulation. I'm not sure what the Chinese equivalent of sushi bonds would be, but so I would like to know who buys these bonds.
Excellent question, excellent comments, and I really want to compare China with Japan. And previous Bernie's paper, also discussion between China and East Asian tiger country who face all these exchange rate shocks. So let me explain to you who a buyer. What's the background for that? After 2008, global financial crisis, after the U.S. Federal Reserve QE, dollar interest is getting lower, borrowing costs is going lower. A lot of expectation think about dollar is going to depreciate, RMB is going to appreciate. That time is not only China. That's why the paper by Bruno Xing, the paper by Ugo and his colleague from Latin American banks, they document that time massive EM countries, non-financial corporations issue dollar-denominated bond in New York for Brazil case, and in Chinese we issue a lot in Hong Kong. And then I also ask a lot of people in the industry, who's a buyer? Because one guest says they don't know Chinese market. Maybe as a Marlene says, they contract enforcement, they don't understand this. More important, I think, maybe coming from that time, most popular products, so-called EM high-yield bond. Emerging market corporate issue high-yield bond, okay? Then a lot of investors from the finance centers, mutual funds, financial institutions, they invest a lot that period for EM high-yield bond. So ideally, maybe next paper we can match whose buyer is domestic or international to make that story more comprehensive. But so far, this paper we try to answer three questions. Number one, why they do dollar-denominated bond issuer? Now, guess it's carry trade. Okay, carriage benefit. Especially, we think those people are risky sector. They cannot borrow domestically because regulations. Then, as long as they access international financial market, they do a lot of this carry trade. Second, we look at once they borrow money, what's they doing? They are not do any investment. They are not do any cash holdings. Instead, during that time, because all the risky sector got hit. So A risky firms got money come back to China. They lend to B firm in the same risky sector, so-called interfirm loans, especially when carry trade is higher. And finally, we want to see the spread. That's why we use interest loan data to calculate dollar borrowing minus interfirm loans, the borrowing cost. We do also found out the real effect is especially stronger for the spreads higher, high demand for borrowing costs in domestic China. So this is the three dimension we want to on the line with your guests. It's a lot of insightful suggestion. I want to go back to read so-called Chinese version of sushi bond. Maybe next version we are going to have a discussion for that. Thank you very much.
All right. The time is almost up, so let's take one more question, or one or two. Steve, you can unmute and just ask your question.
Yeah. Thank you very much. So just a really quick question on how much do we know about currency mismatch and maturity mismatch in this issue? Because I see firms issue bonds. I think it's in long maturity, and then I think you are measuring in receivables in interfirm loans. So these are presumably we have some maturity mismatch, right? Do you have any more concrete investigation on these dimensions?
Yes, excellent question. We do look at the spread, or do look at maturity. We do look like short-term versus long-term, who's borrower risk sector. Interestingly, I get rid of one very nice newspaper articles. So give you an example. Most of them, they issue short terms, okay? Short-term maturities. And very interesting thing, recent issue in terms of maturity come to the end. So one of CEO for steel company, risky sector, from Dongbei Special Steel Company, the CEO once also dollar bond, but also borrowing come to the maturities. He committed suicide by himself to avoid all the bankruptcy or debt overhang problems. So a lot of this kind of drama due to these kind of short-term maturities and what borrow short terms, high interest rates, high yield, lend to another firms, okay, to risk it, interfirm lendings. That is a story. We do look at the maturity, but maybe in next version we put some maturity as a high and with low to document all your insights or test or your hypothesis. Thank you very much. I also saw one question from Bernie. So
yes, that will be the last one.
Okay. Indeed, risk. Okay. Please.
One thing in my mind when we talk about carry trade and mismatch of currencies and terms is the Asian financial crisis in 1997. And the thing that scares us is really the information asymmetry. The borrower has a problem. Either the borrower or the lenders may be surprised by currency change or policy change. So my question is this. If I was sitting there before 2015, I would be happy to lend to the Chinese, those that are qualified to flow a bond in New York or in Hong Kong, because I know that there will be the government bailout, and also I know that the government hold the exchange rate very steadily. So there isn't any surprise in the near future. So my question is do you see any information asymmetry or wrong expectations of policy changes? So that's question number one, and that's what scares me. The second thing is that we know that there is really a lot of changes in regulations since 2015. Including relaxing of the interest rate ceilings and floors, and also allowing a lot more the qualified foreign and domestic institutional investors into the bond markets, etc., etc. So, do you see any changes after the policy changes? And by the way, as far as I could tell, there was no default whatsoever for all those borrowers. So the lenders are pretty happy.
Okay, excellent.
By the way, also I think that for the domestic internal lending, many of these borrowers are connected party and they lend to their own subsidiaries. They are not lending to independent, and all these risky industries and what the government tell them you cannot use public money, but if you use outside money, go ahead.
Excellent. We do, let me reverse orders. Indeed, we do look at whether you belong one group or another group, or you look at same industry, same risk sector, same industry or not. We do have a lot of discussion about information asymmetry, or do it's a liquidity problem, it's an information problem. But one thing is first question is so important for now study, because at the beginning for this project, we want to understand the potential risk, right? About more like a potential risk. Later, we look at a more real effect. Let me explain to you what's potential risk. So previously, all this kind of more than $400 billion US outstanding borrowing through the bond issuance, they mainly through this kind of a risky sector, lemon firms, non-tradable sector, they never have any so-called operation hedge. They never have foreign incomes, cash flows. First one, they don't have, they seldom do any, they never do any operation hedge because they're non-tradable sector, real estate. Okay. Secondly, whether they do financial hedge, no, because we have another regulation from now in the name of financial stability. Big Chinese corporate, you cannot borrow for FX derivatives to against exchange move, because we have a CTEX security have big problem in Hong Kong. They bought some toys and assets. That's why central banks, regulators said don't borrow any financial derivative to against currency risk. Secondly, thirdly, what's the kind of policy change? It's very interesting. Market at that time have one-way bet. They think RMB is going to appreciate, dollar depreciate during summer period, 2008, 2014, until 2014. There was a very dramatic change in terms of RMB appreciate or depreciate to against market expectation through the central bank operations. So because at the end of my summer period, I do have a discussion in terms of how this kind of exchange rate, appreciation, depreciation expectation through the central bank policy to lead to this kind of a very severe FX risk. Basically, those firms, they are heavily in the debt of a foreign currency. Then they cannot hedge it. Then when exchange rate to another way around, they got big problem. This is first one, financial risk. Secondly, once they borrow money, they not put it in the bank to gain the risky, get more safe returns. They lend to other firms to gain also interfirm loans, also even more risky activities. That's why this paper will try to combine two things together. More internet exchange rate, and that's one is domestic shadow banking activities by Chinese non-financial firms. Thank you.